This is your fourth program in the series on the principles of accounting. An automobile driver must know how fast he is driving, in what direction, and at any given time he needs to know where he is. In the same way, the owners and managers of an organization must know their costs and income during a week, a month, or a year, and their situation or condition, say on December 31st or June 30th. If every transaction has been properly entered into a firm's books of account, a list of these accounts and their net balances provides the first stage for reporting the operations in a period of time which has just ended, and the financial condition at that time. What is the name of this list of accounts and their balances? Right. This list of accounts and their balances is also useful in making the periodic adjustment in the accounts, such as depreciation and prepaid expense, in closing temporary equity accounts of revenue and expense, and in preparing the periodic financial statements. When such a list is written with several sets of columns to do these things, what is it called? Yes. Worksheets aren't financial statements, of course. They're just aids to preparing them and for proving the accounts. Usually no one but a bookkeeper or accountant ever sees a worksheet or even a trial balance. The first two columns of the worksheet are for the initial trial balance, the list of accounts and balances. Errors are checked and corrected at this point. Then the next pair of columns may be used for entering periodic adjustments such as depreciation, with a third pair used for the adjusted trial balance, combining the first two pairs of columns. Adjustments include the replacement of beginning inventory with the final inventory, the recording of interest expense which has been accrued but not yet paid, and interest income earned but not yet received, the recording of prepaid expenses like insurance, and supplies which have been used up and expensed, recording depreciation, and entering a reserve for bad debt losses. Which sort of entries are the most likely? Yes. To remove the beginning inventory from the merchandise inventory account, you credit that account, and to enter the ending inventory into the merchandise inventory asset account, you of course must debit it. In each case, the offsetting debit and credit entries are made to the expense and revenue summary which you are preparing. Another end-of-period adjustment is made by debiting the asset account, accrued interest receivable, and crediting the temporary revenue account, interest earned, by the amount of any interest which has been earned by the end of the period. The reverse is done with interest expense. How would this be entered? Right. The prepaid insurance account is set up when the policy is paid, or set up as a payable, but charged off as expense proportionally to the time expired of the insured period. If the insurance premium is $200 per year, and it was first purchased on September 1st, how much insurance expense has been accrued by December 31st? The next pair of columns may be used for the income statement and the last pair for the balance sheet. The income statement includes extensions of sales, sales returns, purchases, purchase allowances, discounts, and interest earned, as well as the various expense accounts. The amounts from the expense and revenue summary accounts are also carried to the income statement columns and totaled with the sales, purchases, and expense accounts mentioned. The difference between debits and credits, then, is the change in owner's equity during the period. What's another way of saying change in equity due to operations? Yes. The asset and liability accounts are carried over on the worksheet to the last pair of columns for the balance sheet. These include accounts such as bank checking accounts or cash, petty cash, accounts receivable with contra-asset account allowance for bad debts, notes receivable, inventory, prepaid expenses, if any, such as insurance and supplies, equipment assets such as furniture, fixtures, automobiles, machinery, and so on, and their contra accounts for accumulated depreciation. Liability accounts in the balance sheet column would include accounts, notes, and accrued interest payable, and FICA, unemployment, sales withholding, and other taxes payable. Besides assets and liabilities, what else do you think should appear on the balance sheet? Right. The totals of the assets, liabilities, and permanent equity entries in the worksheet which have been carried to the balance sheet columns are now subtracted. If the debts are larger, there's a profit. If credits are larger, a loss. Notice which items are debits and which are entered as credits. This difference, profit or loss, should of course be the same as the differences between the debit and credit totals of the income statement columns. This income figure should be recorded on the next line down on the worksheet. A profit will, as you can see, be a debit in the income statement and a credit in the balance sheet columns. Now you can write the equal balance totals on the bottom line. It is relatively easy to understand why income must equal the difference between total revenues and the total of the cost of items sold and the expenses during the period. But it is not quite so easy to see why income or profit also equals the relative change of assets compared to change in liabilities during the period. Before entering a net profit in the balance sheet columns of the worksheet, how are their totals out of balance? Yes. It would seem reasonable that if during a period the assets, which are debits, increased more than liabilities, which are credits, a profit was earned, unless more capital was invested. Net income would also be indicated if liabilities decreased more than assets, or also if the assets increased and liabilities decreased. If in a period with no change in owner's investment, a firm's total cash, net receivables, inventory, equipment, and other assets increased from $50,000 to $56,000, and its liabilities increased from $20,000 to $28,000, what happened? Right. The income statement is the most useful report for providing information about profit and loss and why it occurred. It states the amount of revenue, the cost of the goods sold, and the amounts of each of the expenses, as well as the net profit during the specified period. The balance sheet, on the other hand, shows the amount of each kind of asset which is owned at a specified time, as well as the amounts of each kind of liability and the amount of owner's equity. Which statement would you look at to find out how much rent was paid? boom times especially, the income statement is considered the more important financial report, since even a small or weak company will become big and strong if it shows substantial and consistent income. The income statement is also sometimes called Statement of Operations, Profit and Loss Statement, or P&L, Revenue or Income and Expense Statement, or Earnings Report. Be sure to use such a title, as well as the period and the name of the firm, as a heading for the report. Creditors, income tax agents, management, and owners all wish to see the income statement. They decide respectively whether to lend money, ship goods, audit tax returns, ask for a raise or promotion, or stay in or quit the business after reviewing the report. Since income or profit is what is left over, it is customary to put it at the so-called bottom line, an important position. The top position, also important, is usually held by total revenue or sales. Next, sales returns are subtracted to provide net sales. The purchase cost, including freight and other direct costs of the goods sold, is then subtracted to provide gross margin. Which report would be most important to an IRS agent? Yes. Notice the reducing order of differences. Net sales after returns are subtracted, and gross margin after cost of goods sold is subtracted. Then the total expenses, which are itemized and indented, are subtracted to obtain net pre-tax profit or net operating income. This is the bottom line. Income statements are and should be rather clearly written and arranged, but an experienced person may be able to learn more than others by studying it. One way to find out more about what happened is to compare the statement with previous income statements. The second quarter year income may be compared with the first quarter or the second quarter of previous years. To assist any reader of your income statement, you may add extra columns with this earlier information so that each revenue and expense item can be compared with a comparable earlier period. Would it be helpful to learn that although sales were higher, profits were lower because interest expense had increased? Yes. Sometimes it is helpful to simplify the numbers by reducing them to percentages. For example, if sales in the first quarter were $41,000 and gross margin was $12,300, while second quarter sales and gross margin were $59,000 and $13,000, what would you notice? Right. Percentages might help you notice trends in costs or expenses. Obviously, the actual dollar costs are important for relatively stable expenses such as rent, utilities, salaries, and supplies, so changes in dollar amounts are also revealing. When economic conditions are not booming, the balance sheet may become the most interesting financial statement about the firm. For even when there is little profit being earned, if assets exceed liabilities substantially, the company can continue in operation. What factor is made up of the difference between assets and liabilities? Yes. The balance sheet is also called the statement of assets and liabilities, although it also includes equity. Sometimes it is called statement of condition or statement of financial position. Clearly, creditors and potential creditors, such as suppliers and bankers, and government agencies of various kinds, as well as managers, owners, and prospective owners, wish to see the balance sheet. The report
form of the balance sheet or statement of condition merely lists assets, liabilities, and equity in turn on a single column or page. The account form of a balance sheet has the assets on the left and liabilities and equity on the right, often on a facing page. Such an arrangement is suggested by the left and right arrangement of an account sheet, with the debits or assets at the left and credits, liabilities, and equity on the right. At the top is the name of the organization, the term, balance sheet, or equivalent, and the date for which the report applies. Why doesn't it refer to an accounting period? Right. Accounts, short-term notes receivable, temporary investments, and inventory are current assets, while accounts and short-term notes payable, taxes, salaries, and the like are current liabilities. Relatively long-lived equipment and facilities are fixed assets, and their purchase cost less depreciation is their remaining or book value, which approximates their market value as used assets. Land is not depreciated since its value doesn't usually decline. Notes, including mortgages, which are payable in later years, are classified as long-term liabilities. Which of these is a fixed asset? In analyzing balance sheets, comparative figures from earlier dates are useful to note changes or trends. Fluctuations in cash are relatively less important since receipts and disbursements fluctuate, but factors such as the quick assets, including cash, receivables, and the like, are of interest, as is the ratio of current assets to current liabilities, total liabilities to equity, and similar ratios. Current assets less current liabilities are called net current assets or working capital and have obvious importance. What reports would you prefer to see if you were a banker?